All right, hold on, Joe. Just give me a second. All right, let's do a quick sound check. Can you guys hear me okay? And also the guys over on YouTube as well. Can you hear me okay?
Yes, Frank is good.
All right, good. Thank you. What about you, Joe? Can you hear me?
Yeah, I can hear you.
All right, so let's go. Let's get started.
Tuesday night, about 8:15. Wednesday, June 17th, about 8:15 Eastern. Thanks for having me, Frank. I figured we could just take a look at some charts, take some questions from people.
Yeah, here's my first question. Do you have any SPACs?
I'm forming my own SPAC right now.
Any OPES or any of these conglomerate shell companies that you have in mind? That's what the people want to know.
That's all we need. I wish there was a way to just screen for SPACs.
By the way, there is, and by the way, this OPES, this is a burger company.
Is it really?
Yeah, I don't know if it's a burger truck. Might be a burger truck, but one of my friends is doing the deal.
Oh, that's funny. I'm gonna do my own taco truck. Let's just do that. Let me see. Should I share MarketSmith?
Yeah, go ahead.
Let's pull this up here. Thank you everyone for attending. Hopefully you can see the MarketSmith here. My basic thing with the markets right now is there's just very little distribution. In part of my process, what I do for the overall picture with the markets is I look and see if, if we're having up days, if they're coming on good volume, any down days on heavy volume. Last Thursday was, let me pull out the pen here. Last Thursday was a distribution day, and I tweeted out a chart of this last night. Last Thursday, June 11th, was a distribution day, which is defined as a down day on heavier volume than the previous day. And then June 4th here was a distribution day on the NASDAQ, which was also a down day on heavier volume than the previous day. But other than that, there's not really much distribution. And as I've always said, the big institutions control the market. So you got to track what they're doing, and they're not really selling. They're just telling us they've accumulated shares this whole way up since we bottomed in March, April. And they've accumulated shares, and there's just very, very little selling. So I'm not going to argue with it. Are we going to see pullbacks, shakeouts, corrections along the way? Absolutely. But we're in a strong uptrend.
Joe, we already saw a pullback. That was an 8.5% pullback in the S&P 500 and 13%, if I'm not mistaken, in the IWM in a matter of a couple of days.
Yeah, look at that. This is the chart of the Russell. You're right. Do you think that because it seems to me like everything's so fast, do you think that instead of the normal 6 to 8%, 6 to 10% pullbacks we see over a few weeks or a few days, do you think that everything's just on steroids and it's all happening quicker and that's it?
That's
obviously nobody knows, but I'm just curious.
Nobody knows. But what it looks to me is, it's, for example, everyone hits the exit button at the same time, and then, days later they're like, "Oh, I made a mistake. Let me buy them all back." With reckless abandon. That's what's been happening. If you look at the IWM, we're talking.
Go ahead and share your screen. Go ahead if you want a new share.
Okay. If you look at the IW, this pullback was done before I was able to finish my coffee. This is 12.5% from Monday to Friday's low.
So when the market's 10% is a correction, 20 is a bear market. So we had a correction in the Russell.
We did.
We just had it. It's on steroids. And I don't know what the explanation is. Just things are fast. And it happened in what, 3 days?
3 days.
It's unbelievable. And what'd you say? Yeah, the NASDAQ and S&P were what, 6 or 8% roughly around there in a couple days?
Yeah, the SPY we're talking about here, from this high to this low right over here, was roughly 8%.
Yeah.
That's nothing to sneeze at.
And that's normal in an uptrend to have these 8 to 12%, 6 to 8% pullbacks. I'm just used to seeing them, I don't know, in a few weeks and things calm down, but at least a little bit of time, but they're just, 6.5% one day on the S&P on Thursday, and then just in the S&P, the NASDAQ down 525 points, stabilize, Come right back.
And by the way, guys, in the meeting, and if you're in Zoom or in YouTube Live, please ask as many questions as you like. We'll make this a little bit more interactive.
Yes,
And by
please.
asking questions, you're going to get more out of it. What else are you seeing? Well, I mean, look, we have, all right, so we had the stories about these, whatever you call them, SPACs, shell companies, conglomerates, OPES, Graph. What do you think about that?
Look, short term, in general, when you start to see these cheap stocks and a lot of speculative names, it doesn't mean it's towards the end of the move, but it definitely is. It is a little bit frothy. But one thing I'll just keep in mind with some of these and with the whole Robinhood traders and all this stuff, when I started 96, 97, 98, and a bunch of my friends were putting money into, Ameritrade, Fidelity, just all these online accounts, right? They started doing it 97, 98, and then everyone would say, I mean, there was no social media then, but everyone would say, oh my God, it's a top, it's a top, it's a top. It went on for 18 months. It went on for 18 months. So my point is, can you see speculation? Absolutely. Can the market have a convenient way of every once in a while knocking it down 6 to 10% really fast to shake out that speculation? Absolutely. But can this go on longer? Yes, absolutely.
There are some serious shakeouts in some of these stocks. These stocks are not, here's one carve that was up, I don't know, from 241 to $20 and change. And it closed down at 773. So there's a lot of speculation going on. And these people a lot of them are just buying into the frenzy, and they're top taking some of these names.
Yeah, you got to be. I mean, I'm sure you're going to say the same thing. You got to be careful if people are trading this stuff.
Right. And underneath the surface, by the way, the breadth indicators that I follow, they are levels that we've never seen before. As far as the amount of stocks up a certain amount for the month, we've never seen anything like that. Well, let me just rephrase that. I didn't have these numbers in 1998, 1999. So it more than likely it was something similar to back then. And like you said, that doesn't mean anything at all. It doesn't mean it's going to stop tomorrow.
What is that when you normally see those numbers, and you do a great job of keeping the track of all those stocks up a certain amount, number of new highs, all those internal stuff, and there's different ways to keep track of internals, but with your numbers, what does that usually tell you?
This is not normal. It's not normal. The numbers are way, they're way above what high used to be.
Okay.
Not even in the same ballpark.
So normally you see some sort of a pullback or some sort of a maybe correct through price or through time after you see those numbers, huh?
Right. And it just hasn't happened. It's just, it's been,
I think this is speaking to how resilient the market is. Ryan Dietrich had a great stat. He said the S&P was just up 3 weeks in a row over 3%. And it's only happened one other time since World War II. And that was September of 82. So
right.
if you look at a SPY weekly chart, on a SPY weekly chart, the stat is it was up 3 weeks in a row, 3% or more. And that's only happened since September of 82. Now, I'm not saying this is a new bull market, but the thought of this being a new bull market would just blow everybody's minds away.
Right. Well, that's a sample size of one, Joe. Come on.
I know, but I'm just saying it hasn't happened. It hasn't happened.
Right.
You're right. I mean, it's just so rare. But again, even Marty Zweig with these breadth thrust indicators, when you get these powerful moves off of the lows in a short period of time and a number of stocks, I mean, yeah, overbought can stay overbought, but I still think we're going to see these quick shakeouts along the way to keep the bulls in check.
Right. And I think for those people, the people who are at home trading, there was a lot of people that were afraid on Friday to buy anything. For me, as a swing trader with my short-term time frame, I get excited when the market is down multiple days in a row. That's when I get excited to put new long ideas, not when the market is already up 4 or 5 days in a row. So that's something to think about, because even if you look at the S&P 500, it's not often that the S&P is down 3 days in a row, 3 or 4 days in a row. And when it's down that amount, typically you get a bounce. So as a swing trader, that's when you really want to be aggressively looking to put long ideas into play. And also, For those of you guys who are swing trading or trading, let me give you a piece of advice. Just don't look at the indices every day, or don't try to make sense of it every single day.
It's a great point. It's a great point.
Just take a look at whatever it is that your watch list, see how that is performing. And regardless whether or not you think, like, for example, Joe, I can think whatever it is I think about the market, and I still do my homework. Okay. Every single day. Because, I could be wrong. I mean, maybe I'm looking for a pullback, but maybe I'm wrong. But my rolling 5-day watch list, stocks that I have on my list for the last 5 days, that tells me the entire story of the market. Now, I don't follow the S&P 500 or the indices as closely as you. But what's important here is that we need to understand that we don't trade the market, we trade our beliefs about the market. So whatever it is that you believe in, just make sure you do your homework and make sure that you know the flaws and some of the pitfalls of that trading strategy.
Yeah, no, that's a great point. And so, I mean, this first question I see in the chat here is someone says, so in this current market, should we continue buying or should take some precautions and go slow? I'll let you answer that as well. But my first comments to that is, well, it's impossible to answer because you need to know your own time frame. I mean, I shouldn't say it's impossible to answer. It's the answer is up to you.
The answer is both. Do both.
The answer, yes. So if you're a longer term investor and you're in from some lower levels, and me personally, I'm not seeing much distribution. Are we going to see shakeouts along the way? If you can withstand an 8 to 12% pullback, if that's what we're going to see in a normal uptrend, if this continues, then you have to determine that. Now, you also have to define, and you talked about this too, are you a trader or are you an investor? Because if you're a trader, I see nothing wrong with either taking some profits into the strength and looking to buy back on the pullbacks, like you said, those 3 or 5 days down, or trading around a core position, meaning you have 100 shares of something at 50. If it goes to 55 or 60, maybe you take 50 of it off, keep that core position, and on the pullbacks add to it. But I'll let you answer that question because I just think it just really depends on everyone's personal.
I think you do both. I mean, look, I think you continue again. You got to have a strategy, right? That's number one. And you always have to be cautious in the market. I think the more importantly, I might be reading this wrong, but we have to learn how to accept that we're going to be wrong, that we're going to have drawdowns. Once you come into terms with the fact that you're not going to be right every single time, and you're not going to make money every day, every month, every year, perhaps, you're going to be okay, right? So the market goes up and down, not up or down. So you're going to have losers. So, like, for example, I take the trades as they come. Now, based on what I believe the market is going to do, or it's doing, and where it's at, I might change my allocation. I might get more aggressive. I might get a little bit more conservative. But the point is that I won't be able to avoid the unavoidable, which is taking losses. And I think that is one of the biggest issues that people have, is taking losses. There are too many conflicting energies where they just don't want to take losses. And that's part of the game. Now, Joe, do you have to be right 70% of the time to make money?
No, if I was, I don't, there's very, very few. I think the best in the business are up 50%.
The best, right.
Long term. Yeah. These people on Twitter, I hit 97% and 78%. Get out of here. They're full of it. Like, this is the example I use, and people can adjust this according to their own time frame. If you buy 3 stocks, if you make 20% on one and lose 7% on the other 2, what are you right on? You're right 33% of the time. You buy 3 stocks, you make money on one, you lose on the other 2. But the key is, if you make 20% on one and lose 6 or 7 on the other 2, you still net a profit. Now, you should adjust these levels. A friend of mine day trades. His numbers are 3% and 1% loss. 3% profit is his target, 1% loss. You should adjust these roughly and shoot for 2.5 or 3 to 1 win-loss ratio to at least make up for not being right all the time, because I agree with you. People have trouble accepting they're going to be wrong. We're professionals. We're wrong all the time. You just have to minimize those losses and correct things when you're wrong quickly.
Right. And don't allow the previous loss to get you in a state of depression. And don't allow the last two winners to get you euphoric where you're just going all in on the next one. Now,
Yeah.
Joe, there's a question here, Joe. What's happening with FSLY? Well, it's going up. That's what's happening. I know.
I think Fastly was a high tight flag. It got really tight about 3 days ago on Friday. Right on. I mean, one thing I did a talk with Mike Webster, and I know he did a great talk about the 21-day EMA is a great area.
Let me hold on.
support.
Let me just stop you there. For those of you who did not watch that video, where was it? Market Rant with Mike Webster.
With Mike Webster and Arusha Paris and Tom Canfield. Yeah.
That was an incredible video. Okay, it's an hour and 35 minutes. I went right to that. You know, I didn't watch the little cut ones. I watched the whole thing, and that was amazing. Amazing, how they are still learning and how they're still changing the way they view things. That some of the things they were doing before, they're no longer doing. And what else was amazing was that these guys worked together, whether it was Bill O'Neill, who worked with Mike and Arusha, and they all do things differently.
Yeah.
Although they are in the same, the same room, same office, and they all have to, share pretty much the same principles.
Yeah,
So
no, and that's a great point you're making. And sometimes I'm assuming too much of people have seen it, but this is always, I've been doing this 21 years. Frank, you've been in the business for a while. We're always learning. We're always learning. We're making mistakes. If you think people, because of social media, and we all, social media, like they say, it's not who we are, it's who we want to be. So don't read everything and think everyone's doing awesome. We all struggle, but we all have to learn from our mistakes and constantly adapt and constantly retest things. And we're constantly learning. I'm learning stuff every single day. And when Mike Webster told me, and he's an amazing market historian, amazing portfolio manager, he just said, look, we've done studies in the 21-day exponential moving averages where the studies show you find support in the markets and in strong stocks when we're in uptrends. So speaking of Fastly, it found that support there. That's your guide, but you just don't want to be chasing something. Had a great day today. You don't want to be chasing something when it's extended. So someone says, what's happening with it? Yeah, it's going up, but you want to be buying this when it's coming off of a consolidation, not chasing it here.
Right. Here's another question. Thoughts on VBIV? Well, you should have asked me, Dan, before you bought the stock. Oh, no.
I don't know this one. I'll let you take this one. I don't know. This
look,
one.
it's a $2 stock. It probably has something to do with COVID-19.
Vaccine percent. Yeah, I see that. Yeah.
Yeah, look, it all has to do with your time frame. Okay, if you're into the story and you believe in the story, then give yourself a wide enough stop to let the story play out. Okay, if you're trading this for a short-term trade, then hopefully you got in before the spick bar. Remember to sell some on the way up and protect some of those profits. And again, look, I mean, sometimes anything can work. Anything can work. And you can have a stock up 10 days in a row and they'll go up the next day. Anything can work. The question you have to ask yourself when you're looking for technical setups is, would I take this trade if it shows up the next 1,000 times? That's what you need to ask yourself. If you want to put in sports term, would I take this shot from the other side of the court every single time I have it? And if the question is no, then you shouldn't be taking that trade in the first place.
That's a great point. There's a question about, well, someone's saying, people are asking how the market can be up. And I say, I don't know, but it is what it is, and move on. I like that comment. It basically is kind of saying what I'm saying is, don't argue with the markets. I love the expression, don't focus on what you think the market should do, focus on what it's actually doing. So like you said, we all trade our opinions and we all think, well, this is ridiculous and what the Fed's doing and the economy still sucks and blah, blah, blah. I say shut out the reason someone might have that opinion is because they're watching too much news. Shut out the news and pay attention to the price action and let that lead you. Whether you agree with it or not, it's not the point. Our job is to analyze the markets and do our best to take advantage of it. And
sometimes the less you know, the better off you are.
I agree. Ignorance is bliss, my friend.
That's just the bottom line here.
Frank, will you go through PRVB?
Yeah, didn't this stock just recently do a secondary offering?
Yes, they did. This is it came out of that range and they had some data during the day on Monday, and then they just did a secondary as well. I know there's some sharp Perceptive Advisors is one of the sharp biotech funds I follow. Joe Edelman, he's got an amazing 20-year track record or whatever it is. It's just amazing. It's one of his positions, and I mean, it looks decent here. It looks decent.
And again, if look, you have to know the reason why you're buying the stock. If it's for technical reasons, if it goes against you, then don't start looking and just don't start reading about what the company does. When you go into a trade, before you hit the buy button, you should know your buy stop and your sell stop. Where is the point if the stock goes down? When am I or where am I going to take that loss? That's what's important. All you have to do is follow the plan, and you follow that plan for the next 1,000 trades. That's all you need to do. Here, do you hedge with the SPY when you take a long position?
I don't, because I find I don't correlate to the SPY. So sometimes my stocks are all down and the SPY's up, and then it's the most frustrating thing in the world. That's a great question. I would rather reduce a long position than hedge, because I don't like to focus on, and I'm not trying to be I'm not trying to complicate things. I don't want to focus on too many different things. If I got 100 shares and I got a nice profit, maybe reduce it down to 70 instead of buying. There's a lot of different ways to do things. You can write a call, maybe you could buy a put on it, whatever. I just prefer to reduce the share size than to get complicated. Like, especially the worst feeling is when you hedge on the index and the index doesn't go down or even goes higher and your stocks go down. So I don't hedge with the SPY, mainly because I don't correlate to the SPY.
Right. And not only that, the rotation, right? And I mean, you can have, for example, you can have the SPY underneath the surface. You can have 495 stocks that are in the S&P 500 all downtrending, but those four big ones are holding the indices up, whether it's Amazon, Facebook, Google, whatever the case may be. But more importantly, do you hedge with the SPY when you take? No, you look, if you take a long position, just accept the fact that you're going to be wrong, right? So you don't need to say, well, I'm going to go long this and I'm going to short this just in case the market goes down. No, just accept the fact that you're going to be wrong. You don't need to be right every single time. I think that the fear of losing money, right? And money in the market for the most part is never lost. Someone else just took it for the meantime. And then you could make that money back unless you're playing options, and then that money's gone. But right. I think that what gives people paralysis is the fear of buying something and having it go down. And that's the reason why this game is a mental game, because we have to unlearn all those things that were taught to us when we were younger, where you can't be wrong, you got to be right. And here is the opposite.
Yeah,
you can't stay wrong.
You got to accept you're going to be wrong, and you have to overcome those fears. And that's 90%. I mean, Frank and I can give you all the setups and strategy and hand everything to you on a silver platter. If your head's not right, you're not going to make money.
Right. It's all about execution.
And it's all about execution, but how you're going to execute is going to be based on, you have to learn to overcome those fears. You have to learn to, 90% of the questions I get are, when you're in a stock, what do I do? Do I take some profits? Do I sell? Do I do this? Do I do that? Those are not like technical questions. Those are decision-making questions. And what I suggest, and Frank and I are happy to guide you and help if we can, but what I suggest is making those decisions on your own, starting small and building that muscle. Just like you might start with 5 pounds or 10 pounds to build a muscle, to build stronger weights, and to get more strength. Start with smaller share positions and make those decisions on your own. And that's what's going to help you build your confidence and overcome those fears.
Right. And make them beforehand. Understand why you're buying the stock and have your sell order, when you're going to sell. And look, nowadays with zero commission, you can buy 5 shares, right? You can buy 5 shares. And what you want to get to a point where you're trading with a carefree state of mind, where you're not concerned about the outcome. You're just not. So that's where you want to get, where you're not concerned about the outcome of the trade, whether it makes or it doesn't make. It's irrelevant. That's where you want to get. And then once you're able just to pull the trigger that easily without caring how, what happens to the trade, then you can start to increase your size.
Yeah, that makes sense. What else we got here? For swing trades, do you exit all at once or trim and trail? I'll let you.
Depends. Look, there's no black and white answers, right? So let's say, for example, if I had a stock that, there's a bunch of the stocks that I'm trafficking in are just gapping up pre-market, for whatever reason. And if the stock is up 25%, I'm going to ring the register on the whole thing more than likely. All right. Because that's just based on what I'm looking for in the stock within my time frame. So if I'm looking for a 3 to 4 day move, then I get that 20% move in the gap up, I'm going to ring the register. Something like this, for example, MGNX, setup that I got long through 2051, I'm selling on the way up, slowly but surely on the way up. And as the stock gets to day 3, 4, 5, as far as the up days, then I'm increasing the size as far as selling is concerned. So I do both. Here, LVGO, I'm trimming on the way up.
So it's a case by case basis with your
Right,
stock by stock.
Right, because again, if I get a gap up and the stock is up 40%, what are you gonna do? I'll give you an example.
You'd be crazy not to take those profits.
Yeah, corrects. This thing goes, I bought it at 275 here and it goes to 363 in a matter of an hour. That's 40% return.
That's a huge
Right.
move.
So it's a case by case basis. If you don't get a huge gap up and the stock is just climbing higher, then trim. And hopefully your first sale is your worst sale. And then you average it out as the stock goes higher.
Okay. Someone asked about NET, NET. They also said amazing interview with Webby. Yeah, thank you. I hope to do more of those with Arusha and Mike Webster, mainly because I selfishly have about 20 more questions to ask them. So thank you, and I hope to do more of those and so forth. Net had a monster day today. I mean, it's a great story with CloudFlare and a lot of people working from home, internet security, internet infrastructure. A lot of these types of plays are doing well. And again, similar with, they said it's similar to Fastly. Edge computing, cloud networking, and so forth. I mean, this could be new leadership, but it also depends on time frame. You don't want to buy a rubber band when it's stretched. Could it get more stretched? Yes, but the key is to buy off of a proper base, a proper consolidation. Could it go higher? Absolutely. But again, I mean, it's a great company, but just know your time frame and look for either a consolidation to buy off of, or in this case, I would wait for a pullback.
It just came off of a tremendous consolidation, like a month consolidation, and right before it took off, it printed an inside day on extremely low volume.
Yeah, look at that.
Right? That was it right
clue.
there.
That was a great clue.
Today, in the room, I said we missed this one because I scan for inside days every day, and this is a picture perfect sideways for whatever it is, 20 to 25 days. At the very end here, it starts to contract. It prints an inside day on extremely low volume. That's it right there. So again, you need something like this. It's a great story. Some of the same hedge funds, whether it's White Rock or Whale Rock,
yeah.
That owns Fastly, also owns Net. They own a decent size. But again, if you chase, you need a wider stop. That's just basically it. You need a wider stop. You're going to need something like a 20% stop. This thing can easily go down to, down 14, 15% right over here and still be technically intact.
Yeah, I agree. What else do we have? Do you ever purchase leaps? That's a great question. I don't personally, but I think that could be a way. My theory with options is the longer you give yourself time, the better off you are. I think there's too many people getting caught up in weekly options because I know everyone jokes it's a casino and all this, and they can't afford Amazon and Priceline and are now booking or whatever. Are these like Apple, these $200, $300, $400, $500 stocks are higher, so they're trading weeklies. I would suggest staying away from that because they're priced for perfection. Unless you get lucky, they're just very, very difficult. I prefer, once the question is, have you ever purchased Leaps? If you are going to go, give yourself at least 3 months, 6 months or longer, and give yourself some time.
No, I mean, Joe, Leaps, we're talking. I mean, when people mention Leaps, I'm taking a year out.
Yeah, no, Leaps. Yeah, they're thinking, yeah, January 2021 and January 2022. Yeah, so you're right. 6 months to 18 months out. Yeah, or a year to 2 years out. You're right. But I'm just saying in general with options, at least give yourself 3 to 6 months. And I don't think there's anything wrong with Leaps. It's a way to participate in a stock. It just unfortunately with certain stocks like the Amazons and Teslas of the world, the leaps are absolutely astronomical. So I would pass. You know, what are you going to do? Buy one contract for $170? It's like, I mean, I guess you could, but I would prefer to give yourself time with options. Is my whole point. A guy like Stephen Place is a great guy, can help you with that because he knows way more about it than I do.
Right. I have one here. Hey, Frank, just curious. When you say you have a core position on the SPY that you trade around, is this core piece something you've never sold? The reason I ask is my niece just graduated and I'm going to convince her to put her first paycheck into the SPY or the Qs, then give her some advice over time to add or subtract. Right. So if your niece just graduated, she's young, time is on her side. The market has a history. The market, as in the S&P 500, has a history of going higher over time. The more time you have, the better off you're going to be. So my suggestion for your niece is, right, just put some money in, dollar cost average. All she needs to know is a couple of things. Number one, that from 1923 till 2020, I think 70% of the years we had, or maybe 2014, we had 63 years that were positive, 24 that were negative. That's all you need to know. So that's a 63%, 65% batting average. Also, let her know that the entry year decline, the S&P 500 is 15%. So that's normal. You get a 15% pullback. It happens almost every single year.
Yeah.
Not to get scared and pull the money out, just dollar cost average. And typically, when someone is when someone, when I have a friend or a family member who's just getting started and they have their 401k, my normal recommendation is very simply, if you can buy the SPY, take half your check or 75% of your check and go into the SPY. The other 25%, leave it in cash. When the news comes out or the world's coming to an end and you put on, CNBC or your local news channel and they're talking about the market, how it's down 15, 20%, recession, that's when you take the lump sum of cash and you put it into the SPY.
Yeah, I think for longer term, whatever the stats are over any 20 or 30-year period, the market's up. So I agree with you. So if you're going to tell your niece to put money in and give her advice on when to buy or sell, my honest opinion, and it's not investment advice, is if you have that long term of a time frame, just add to it. Let's say it's every quarter if you can, or if it's every year, or if you're starting a job and you can put into the S&P or an index fund and you have a long 20 or 30 years, just keep adding to it. Just keep dollar cost averaging, but just do it so you're not trying to time it. So it's just automatic. Like if it's every 2 weeks you get paid, or every quarter, January 1, April 1, July 1, whatever, just blindly do it and add to it as much as you can. And when it's down, and there will be a period when it's down and you want to throw up and you want to cash everything out, if you got a longer term time frame, add, because when things look horrible, we're going to have corrections. We're going to have bull markets and corrections and recessions. And when things look horrible, I mean, no one wanted to touch the S&P at, what it was, at 21, 2200. Everyone's like calling for, whatever, 1600 and lower. No one wanted to touch it, but at least if you blindly bought some, you'd be, it'd be up considerably from there.
Right. Just know the stats and what they are and the history of the S&P 500. And when it happens, and if you are already informed, then you're prepared, then you're not going to hesitate to do what you have to do when the time comes. What do you think of work? Recent price action, please. Is it a buy from a long-term perspective? Again, when I hear a question like that, with all due respect, and I'm assuming and reading into this, when you're saying that long-term, that probably means that you're down. Learn to take losses. This stock work, COVID-19 play. It disappointed, obviously, because the stock went down huge after they reported. on roughly 91 million shares. It's got a little dead cat bounce. What do you think, Joe?
It just depends. I mean, it's an IPO base. It's one of the few software plays that didn't have the metrics that everyone wanted. But if, let's say, you entered it at 25 or 30 and it ran up and it came back down, you drew that line there at 30 and it's holding your levels, then yeah, it's probably okay longer term. If you chased it ahead of the earnings and you're stuck in it, you might want to just be careful, because personally, I think there's better software plays out there. But this is the type of stuff where, again, I'm not making fun of anyone. When they're asking a question, it's because 99% of the time they own it and they just want the validation. If you want me to tell you, yeah, I like it longer term, of course, you know, I like a lot of stuff longer term, but this is where you need to make these decisions. And it also depends, because I have no idea where you entered it either.
Right.
Because
Well,
when you're saying learn to take losses, that how do you know they might have entered it at 20? You know,
right. That's why I said that I could be assuming,
right,
whatever it is. But even if he top ticked it at 40, stock is at 32.40. That's not bad, right? Even if he top ticked the stock and bought
yeah.
it at
Hang
the
in
high.
there, listen to conference calls, get some company reports, go on the message boards, go in the chat rooms.
Go onto Twitter and pump it.
Yeah, that I know that'll do it. No, I'm kidding, but it just depends on your time frame and when you got in. I personally think there's better software names, but you know, there's better merchandise in my opinion.
Right.
Recommended 529 plan for kids. I think there's education IRAs, 529 plans, UTMAs. I think you should just look at all those pluses and minuses. They have a lot of grids on the pros and cons of all of them. That's what I would suggest, to Google that and look at the different. It just depends on what you're looking for, you know.
And the state sometimes.
And the state, correct, yes.
What do you think of holding balanced funds as core holding versus SPY Qs for people in their 50s?
I mean, it depends. I mean,
how long are you going to live? No one knows.
I don't know. No one knows. It depends on. I think that whatever the stat is, 88% of mutual funds can't beat the S&P, which is basically 9 out of 10. So whatever the stats are, I'm not making fun of mutual funds, but they have trouble beating the S&P, and they have higher fees than the S&P or even the Vanguard, whatever, you know, index fund. I think you're just better off buying the S&P. Now, if you want higher dividends, absolutely. If you're older and you want a balanced fund with more income than growth, then there's nothing wrong with that too. But I just, in general, I'm not a fan of mutual funds because most of them can't beat the S&P, so you're better off in the S&P.
Right.
But if you want the income, absolutely be in a dividend, you know, income fund if that's what you need. Some of them might give you 2, 3, even 4% yield, where they're in a lot of those dividend names.
Yeah, but some of those balanced funds, what it is that as you get older, they reduce the equity exposure, give you more bonds. So as you get older,
yes, that's true.
So that, you know, so no, I think that's what it is. Or maybe I'm thinking target funds, where they reduce your exposure to equities as you get older. Again, look, it's not a lot of things beat the S&P 500. So you got to figure that out on your own.
Over time, yeah, it's over time. It's just very, very challenging. So, what else we got here? I agree with you about batting average. Can you show examples how you handled losing trades since the March low? I haven't had any losers since the March low, so I don't know what you're talking about. No, that's a great question. Look, I've got stopped out of some stuff. I basically, the market's been incredibly resilient. I have my stops. I like to use the 50-day, maybe not longer term, but I'm trying to swing things a few weeks, a few months or whatever. If I get a close below the 50-day, I'm usually just going to stop myself out. It's not that I don't want to talk about my losses, is that all my losses are, you know, anywhere from 3 to 7%. A couple get away from you. And I've had some that have dropped 20%, but I already had a 10% profit. So net, I lost 10 on them. I can think of a biotech, ARVN, off the top of my head, is one that I've got stopped out of. I don't know if you want to punch that one up, or
ARVN.
Yeah, ARVN was one that I got stopped out of when it had some data and broke below the 50-day, and I got stopped out. So, and it's gone lower. So that's how I usually handle these, but it's been a healthy market where, so the general guide is I'm using the 50-day, and if we're closing above that or on the weekly chart, the 10-week, that's a general guide for my, whether I'm sticking with it or not. But if it breaks down below that, that's usually when I'm going to stop myself. I don't know if you want to talk about that with, losing trades.
How I take my stops.
Or how do you handle, what is, some losing trades or examples?
Yeah, I do that. Just the same click of the mouse as you do a buy. I mean, there's no, I'm
if it
wrong
hits your
half the
level,
time.
you're gone.
Yeah, I'm wrong. It's irrelevant. I mean, it doesn't, you can't put on a trade without thinking that anything's going to happen. When you put on a trade, anything can happen. I'll give you an example here. DVAX long at 647. I'm a short. My trades last 3 to 5 days. Okay, so here 647. It got above this little inside day right over here. The next day it broke down, and I sold it. Whatever 579. And then guess what? It set up again, and I bought it back and made 10%. So the same way I hit the buy button, I hit the sell button. And when I put on the trade, before I put on the trade, I already know my buy stop, my sell stop, how much I'm risking, how many shares I'm going to buy. And I already accepted the fact that chances are high that I'm going to be wrong, and it's irrelevant. I'm looking for the next 1,000 trades. The key is, like I said before, if I look at this chart right over here, this little setup going through this inside day high, I'm looking at this chart and I'm asking myself, would I take this trade 1,000 times if it shows up? And the answer is yes. And even if I go back to my data and it says that, hey, with this one specific pattern, I'm right 70% of the times, I still don't know the sequence of wins and losses, right?
Right.
So you just take the trade and you accept the fact that you're going to be wrong.
All right, let me share my screens. I got a question on one of the Chinese stocks. Someone was asking about
LK?
No, they got great coffee when they open.
Right.
What's happening with PDD? Is it a legit ride? I don't know this one. Chinese provider of e-commerce platform. Let me say something. So Frank was talking about LK. Let me pull that one up. Just a quick comment about Chinese stocks. So LK was a fraud. There was a short seller who talked about it, and it dropped. Unfortunately, a lot of people got stung on this. So because of this, a lot of people now want nothing to do with anything Chinese, which I don't think is accurate, because me personally, I would rather be in the safer, bigger cap names. And second of all, the other problem is, which I noticed on my screens the other day, is this GSX. The second thing is now everyone just is looking for the next LK. And just like there are crowded longs, this was in an unbelievably crowded short. I'm not saying it's not going to work out, because there's some short sellers I respect that think it's a fraud or whatever. I'm not saying it is. I'm just saying the whole world was looking for the next LK, shorted this down to 27, and it turned on a dime, and it's doubled since then, pretty much. So my point is, instead of looking for the next LK, look for the next Amazon. Lean towards the long side, because shorting is so difficult. And I think what you're seeing in a lot of these Chinese names is everyone just thinks everything's a fraud, and they're shorting them and they're getting killed. That's my opinion.
Right.
So
now he's not going to buy, and now it's going to go up.
No, they asked about PDD. Now it's just like anything else with all these other stocks. Here's your base to buy off of, and it ran up and put in sort of a cup with a high handle. This is your initial base. Can stretch get more stretched and more stretched? Absolutely. But the farther you get away from the base, the higher the probability of at least some sort of reaction, correction, pullback. Could it go higher? Absolutely. But I just look at where stocks are, learn how to read charts relative to their bases, get a chart book and learn all these things, because you don't want to buy stuff that's extended, because you have a high probability. Like I said, an elastic band can keep getting stretched, but eventually it's going to snap back in your face.
Right. So in other words, there are two type of stops, right? There's a wide stop and there's a tight stop. If you have a hard time taking losses immediately, then start with a wide stop. That means that more than likely you're going to buy less shares, but that'll keep you in the trade a little bit longer, and you're giving the stock a little bit more room to work out.
Yes. Yeah, I think that's great advice because to your point about people not wanting to take losses, give yourself some room. So let's say you want to buy something like this and you want to buy it here at 80 and you think it's going to whatever, 100 and something. It also could pull back to 60. So buy a position that if it does do that, that you can sleep at night or it's not going to kill your portfolio if you're determined to buy something. But anyway, someone said Teledoc, Joe, you mentioned this at 25. Nice research. I wish I held on to it from then. This has been a monster winner. I've also talked about Shopify at, I don't know, it was like $30, $35 off that IPO base right here. And now it's 800 and probably going higher. This just goes to show a lesson I've learned in the markets where just when you think something can't go higher, it usually does. And just when you think things can't go lower, it usually does. Moves in the market can go on and in individual stocks can go on much longer than we expect. But the second thing I was going to say is that's where you define yourself trader or an investor. It's so hard to find a Shopify that's going to go up 10-fold or 20-fold. There's just a lot more stocks that are going to go up 10 or 20%. And I'm trying to hit a lot of those singles and doubles and going for the monster winners, which are easy to see in hindsight, but tough to find in real time.
And not only tough to find in real time, but tough to hold. Okay.
Oh yeah.
Through
Absolutely.
earnings, through drawdowns. These are tough things to hold. Here, can you explain what each of you use as a position size for a full position?
Full position is about 5% of the portfolio for me. If I want to start a position, I might want to start with 1 to 3, but about 5%. If it's a bigger cap stock, I could even go up to 10. And that really just is, again, a lot of these questions are personal preference depending on your own risk tolerance. And I just don't think you should own, I think they say 20 stocks is perfect diversification. I don't think you really need to own tons and tons of stocks because the more stocks you own, you might as well own the index. So like a nice, decent portfolio, if you want to be fully invested, would be about 25% positions, maybe 5% positions, keep 25% cash. Those are good guidelines, but it's up to you. I know some people who have a monster 20, 30% positions. That's too much for me personally. I also know some people that have tons and tons of small positions. I don't see the point for that because if you have a 0.5% position, the stock could triple and it's not really going to move the needle for you. So
Right. And like you said, Joe, it's all relative, Joe. We all have different risk parameters. We consider things a little bit different. For example, I mean, I can walk down the street in the middle of a highway and I feel perfectly fine, but someone else might be a little scared. So relative, it's all relative. So whatever makes you feel comfortable. I tend to do my position size a little bit differently is when I back
go ahead, please.
where I back in the risk. So in other words, if I have a $100,000 account and I'm looking to risk 1% of the total equity, that's roughly $1,000. If my buy point is $50 and my sell stop is 48, 2 points away, I think I take $1,000, which is my risk, divided by 2 points. It means I could buy 500 shares.
Okay.
Now, 500 shares times 50, that's 25. That's a 25% position, but I'm risking $1,000. So unless the stock gaps down huge through my stop, the position size pretty much becomes somewhat irrelevant because I'm still risking 1,000. So that's the way I do it as far as that is concerned.
Yeah, and we're basically doing the same thing. We're just doing the math different ways. So if I take a 5% position, round numbers, and I take a 10% stop, that's 50 basis points. I'm risking 0.5%.
Right.
So, but that's where Frank's point is. If you're going to give yourself some room and maybe give yourself a 20% stop, and someone might say, no way, that's too big of a stop. Not if you have a 2% position. 2% at 20% loss is 40 basis points on a $100,000 portfolio. That's $400. That's not going to ruin your life if you take a 2% position with a 20% stop. What it will do, though, is you take a smaller position and you give yourself room, especially if it's something you like and you have conviction in. It gives yourself room to build your confidence.
Right.
Someone says I'm aggressive. Let's say you have $10,000. How many positions would you take and how much cash? It just really depends. It just really depends. You know, I think William O'Neill says under 100,000, no more than 5 or 6 stocks, but it just depends. I mean, like I said, I really wouldn't own much more than 20 in general. There's this feeling, like you said, Frank, about, no one wants to be wrong. There's also this FOMO of everyone wants to be in everything that's going up. You got to get past that. You know how many stocks, and I'm sure you have the same thing. You have setups and you just might have enough positions. You know how many I just let go? Stuff I even love and I trigger and I just let them go. And that's part of maturing as a trader. You can't own everything. So just keep your portfolio in the, as far as if you're you like growth stocks, keep it as concentrated as you can in a lot of growth names.
So you don't use the 10 times buying power?
Yeah, if you have 10,000, put 1 million into one stock, and if it drops 1%, you blow up. Or I think on Robinhood, they end up billing you like then some poor guy got billed like 1.3 million because he had
I think he was negative equity, 700 grand or something to that effect.
just don't pay it. Who cares? I'm joking. Frank, do you have a limit for the number of stocks on your daily watch list? What about number of trades per day?
Right. So I think that Jay-Z, not the rapper.
That'd be
Uh, I
cool if he was in the room, though.
right. I think he's part of the trading room, right? I don't want to take too much time answering that question because I got a ton of videos on that. But do I have a limit of number of stocks in the daily one? Yeah, I mean, you see the daily watch list every day. Uh, whether I have 2, 3, 10, or 15, for me is pretty much irrelevant because what matters is which ones trigger. So we on any given day we can have 10 names and only two stocks trigger. Today we had 15 names, I think, and I think only 3 stocks triggered. So it depends. What about the number of trades per day? Again, that's something that you have to figure out on your own, depending, how fully invested you are, how much buying power you have, how much you're willing to risk. If for some reason I'm not crazy about the market before the market opens, I'm going to say to myself, look, all I'm going to do is I'm going to risk 2% of my total capital today, and I'm going to buy 5 stocks. And that's it. And there's my limit for the day. So you can do something like that.
Yeah, a lot of these questions are case by case basis, number of stocks, number of trades, what to do. Or you sell some, do you hold some, do you sell it all? These are a lot of these, and I'm not saying this in an arrogant way, just experience. The more you trade and the more you get a feel for the tape, sometimes I might like something longer term, but if it gets extended and I just say, wow, this is getting really stretched, I'll dump the whole thing. And even if I like it longer term, I'm just saying this is probably running into a probability of a correction. So I wasn't intending, but if it just runs, like you said, that stock you put on that jumped up 40% in a couple of hours, I mean,
What are you gonna do?
you're not thinking of day trading it, but you'd be an idiot not to take profits on that.
Right, right. So what we have is guidelines. And I think that these guidelines are not set in stone. They're guidelines. And what you want to do is you want to take these guidelines and make them your own to see if they fit what it is that you believe in and if they fit your personality.
Yep. Someone's asking on MHH, would you sell out or hold a smaller core position add on the next deep pullback? I don't know this company. It's very thin, trades 71,000 shares a day. So it wouldn't show up on my screens because my parameters are 200,000 a day, but for an individual, that's fine. It's for information technology, staffing, and so forth. I don't know this company. And again, I just look at something like this and I see this is the base and it's a little bit extended. It just depends on your time frame, when you're in it, what you want to trade. If you got a good level, you're in it at 15 or 20 and it's at 28, you got a nice gain. There's nothing wrong with taking some gains. The question is, should I hold a core position and add on the next deep pullback? That again, it's a personal thing. It's a personal thing. I know some people who want to play out a move for a longer move. And if you got a good entry, these are the sacrifices you make when you define yourself as a trader or an investor. If you're a trader and you take some off, you make the sacrifice, it can go higher. If you're a longer term investor and you say, I want to hold longer term, you make the sacrifice that something like this can come in. These are the decisions you have to make personally, depending on your own, I hate to sound like the disclaimer, your own time frame, your own risk tolerance, and your own objectives.
Right. And what's going to happen is what always happens. Okay. If for some reason you hold on to that last piece and it goes back to your break even price, you get stopped out, you're going to wish that you would have sold it when you first did. And also vice versa. There's always going to be some type of remorse when it comes to selling. And that's the reason, like what Joe said, you need clarity on what it is you're looking to accomplish in the market, or you can diversify your trading. You can have some short-term trades. That these are the short-term trades, these are the parameters, and you can have some long-term trades based maybe on weekly charts. But what you need for exits is clarity, because you're always going to have some type of remorse based on whatever it is a stock did after you sold it. And like Joe said, you're a long-term investor, and the old school trend following. One of the things that people did not like about the old school trend following is that last piece, they always lost a big chunk of that profit.
Yeah. Yeah.
Things went parabolic, and then they're using the 50-day, and the stock goes down 50%.
Yeah, someone asked me about Nvidia because it got a downgrade yesterday, and then I can let you share your screen, Frank. I tweeted this out when it came out of the space, and I even tweeted out the chart. It was right around like 290 or so. That's around where I entered it, 280, 290. And again, talk about this 21 EMA. It's a good guideline. I think this is one of the leaders in semis. Is it a little bit stretched? Yes. It just all depends on your time frame, where you can use the 21 as a guideline. Longer term, use the 50-day as a guideline. Can it go higher? Absolutely. I think longer term, I like it, but you just have to know your time frame, and depending on where you entered it, just trade around that.
So you actually changed your moving average to 21 days?
So I have on my charts, well, on MarketSmith, I have so let me reset here. The 50-day is the red line's a 50-day simple, and the black line is the 200-day. That's what MarketSmith defaults, 50 and 200-day. And I put in a 20-day simple because that's what I've used. On my charts, on my e-signal, I have 10, 20, 50, and 200. Mike Webster said the studies show, because I'm thinking 20, 21, 22.
What's
what
the
the heck's the
difference?
difference?
Right.
Who cares? And someone asked me, and I even said, I don't know. It's close enough. But he said the studies show not just that the 21, but the 21 exponential, his studies, because he has the database of stocks going back forever, and he loves doing these studies. He said that is the level to use. And because of that, I changed it because I trust his judgment. And I've noticed more and more that, surprisingly, when I look at a lot of charts, that it's actually pretty strong.
Okay, so you could actually teach an old dog some new tricks.
Hey, I'm an old dog, and I'm always looking to learn. So, but yeah, so that's just a subtle thing. So, I mean, and you look at it, Microsoft, Nvidia, Amazon, some of these big cap liquid leaders, they've held that level. So it just depends on, but longer term, I like it. But, if we see a pullback in the markets, I would personally, I'm going to add, but we'll see. I do have a position, full disclosure.
And what? And Nvidia. Okay.
Nvidia. Yeah. We'll take a couple more questions. I don't know if there's any in the chat. If you want to share your screen, if you want to do a new share and share your screen, if you want to.
No, that's fine. It's fine. That's
pull up
fine.
something. I don't know if there's any other
That's fine.
questions.
It says here, DT guided higher for the next quarter, but lower for the year. But why is it still rising higher?
Well, my answer to that in general, you can remove the stock and just put an XYZ, is it's not the news, it's the reaction to the news. I don't care what the news is, it's the reaction. I've seen companies beat and guide higher and still be down 20% after earnings. I've seen companies guide lower and be up 20%. So it depends what they say in the conference call. It depends on what the analysts think. The fact that any stock might have guided lower for the year, but it's still going up, that tells you everything you need to know right there. I don't question it. I don't argue with it. I follow price. And, this is coming out of an IPO base and has some great earnings and sales growth.
Right. Here it says, Frank, if you can take a look at Novavax on the 5-minute chart. Oh.
I
Um,
purchased it and got shaken out at 10 a.m.
yeah, look, I mean, it's only a shakeout because it went higher after you sold it.
Yeah, otherwise it's a brilliant sell.
Right. Look, I don't look at five right. I don't look at 5 minute charts, but I think that the lower your time frame, I think the less you should believe in shakeouts because the lower time frame, you're within the noise. Um,
Yeah, this is a high volatile, obviously COVID play.
this thing was moving 2 or 3 points in seconds just the other
Yeah,
day.
you gotta look. Livermore talks. So Jesse Livermore says stocks are like people. Some are calm, some are erratic, some are like Tesla's going to trade different than AT&T, and Novavax is going to trade different than Johnson and Johnson. You got to get a feel for the stock and know the personality, even by looking at a chart. And like you said, this thing's moving 2 points in a minute.
Look right here. Look, I mean, I know because I bought this stock on 6/1 through this inside day, and this thing was moving here, 54 to 51 in a matter of this thing was moving a matter of 15 in 15 minutes. So when you're doing intraday stuff, look, man, you're trading within the noise. So you just have to be quick, and then you buy it back, right? The market doesn't know that you sold it, that you bought it, that your last trade was a winner or a loser. And the fact of the matter is that the last trade has nothing to do with the next trade. So you buy it back.
Yeah.
If it sets up again, I mean, look, some of my best trades are my stop outs. I have zero issues buying stocks back. And as a matter of fact, I just showed you with DVAX, stopped out, bought it again at a higher price. And guess what? The second trade was a profitable one. Just buy it back.
Yeah, can you talk about that? Because I think that's a big, and we'll wrap it up soon, but that's a big problem people have is buying a stock. Some of my dad's friends, I remember I sold that stock at 50. It's at 120. I'm not going to buy it now. Can you talk? I mean, you deal with that, and a lot when you when you're a broker and stuff. What do you tell people about that when something's higher?
Nothing. Look, people make, look, it's higher. It's a different trade. It's just, I view it as a completely different trade. I don't allow what happened 2 days ago affect me what's going to happen in the future. And the fact of the matter is, we don't know the outcomes of any of these trades. What we're doing, this is the market is all about probabilities, and we don't know the outcome. So what you do is that you put on the risk, you accept that risk, and either the trade, either it's a winner or a loser, and it should be pretty much irrelevant. You're a basketball player, you have an open shot, you take this shot, regardless of what the outcome is. If you are a 3-point, if Steph Curry is taking a shot and he's open, he's only going to be wrong if he doesn't take that shot, right? Because he's hoping that is his shot. So you take it and the outcome is irrelevant. And for some reason, if you miss and you're open again, you take it again. So just buy it back and look at it. Look at every trade on an individual basis. Whatever happened before has nothing to do with what's going to happen in the future.
Yeah. Let's do one last one because someone asked us twice about Teladoc, TDOC. If you want to punch that up. The chart looks great. And they said, any thoughts? No EPS, but super strong. I mean, the losses are supposed to narrow next year. 14 billion market cap. It's obviously a COVID play, the Zooms, the Teladocs, telemedicine. I mean, the chart looks good, but one thing I have traded this is I will say it is it trades with a wider range. So if you do trade this, again, like Frank said, just smaller position with just give yourself some room.
You know what has me excited that's similar to this stock? On a weekly time frame, ONEM.
Oh, that recent IPO.
Recent IPO. I don't know, you call this a cup and handle, nice little pullback. This is something that I'm interested in. Let's say, for example, for next week on a weekly time frame, going through this high right over here and using the 10 week, the 50 day as a stop.
Yeah, look at IPO'd at 14, opened around 20, had a nice base. Yeah, it looks good. Yeah, that could pull into the 50 day, and that'd be viable. That looks good. Someone said it would make great psychiatrists. Yeah, I put people to sleep all the time. So. Look, I think I appreciate that compliment. I mean, Frank and I have been doing this for years, and I'll just close it out with this. This is all about mental toughness. This is all about putting in the work. This is all about focus. This is all about, I think trading is 80% psychology, 20% mechanics. It doesn't matter if you're growth, value, trader, investor, short term, long term, it doesn't matter. Whatever your strategy is, you still have to get over the fears and get over all the hurdles that we have in our heads. It's okay to buy stocks higher. It's okay to take losses. It's okay if you're scared about clicking that button, reduce your position size, and you have to take action. You know, it's just these are all things that happen with time. But I think if you're struggling with that, you got to work on that first before you're approaching the markets.
Right. Let me just take this question from Phil Rich, which I feel like I know the guy because we're always
Filthy Rich, yeah.
Yeah, that's what a filthy rich, right?
I love that. I've seen that name. That's a great name.
Right. He entered Roku 175 calls at 3 yesterday. Jesus, 175. The stock at 117. Okay. Yeah, see, the thing is with these options, when you're buying the 175 calls and the stock is at 117.32, it's you're pretty much, you got to play for that quick move, right? I mean, because the time, you know, the more time goes by, the chances are that call is going to be worth.
Well, they're saying it was up 120%. Should I sell half? I know John Najarian, who's the expert in the options, he talks about when you have a double, sell half, because then you're playing with the house's money. You know, so if you buy 10 contracts at $2 and it goes to 4 and you sell 5 contracts, you take your 2,000 off the table and let it run if you want to go for a bigger move. So I'm not saying, you know, should you have sold half? I'm just saying a general guideline is if you get a double in the option, cut it in half and let it run.
Right. And as far as the stock is concerned, this stock had a decent move yesterday on above average volume. I wouldn't consider this, I wouldn't consider just because the stock was down today, I wouldn't consider this a failed breakout or a failed move. I would think that the trade or that breakout, if you want to call it that, fails if it goes through that big bar, big volume low. I think the stock is still intact until it breaks this low here, which is 107.70. The problem is with the options, you got to be perfect unless you have a lot of time on your side.
Yeah. Someone says, thank you. I follow Joe and I'll now follow Frank. So I got you a follower, Frank.
Well, good for you. That's a smart choice.
At Zor Trades.
All right. So listen, where can we find you, Joe, besides on Twitter?
I am at jfahmy, joefahmy.com. Just really quick, I do have an educational product. It's joefahmy.com. There's an investor education. If you're interested, I've got great feedback on it. I put videos twice a week, do things like this as well. And I just love doing this. And
what do you do? What do you put in those videos?
Basically analyzing the markets. I analyze the markets and talk about some of the leading stocks, because the blueprint is education, which is to explain a lot of these concepts, chart reading, fundamentals, technicals, market timing stuff, and not market timing, but knowing when we're in an uptrend, identifying bottoms and tops in the markets. And then I try to take that and apply it in real time in those videos twice a week on Wednesdays and Saturdays. If I will say this, I did put a list of some great leaders to keep an eye on in case we do go higher from now to year end. And again, if you want to check it out, I've got great feedback, and I'm very grateful that.
Listen, we have no issues here promoting. You also manage money.
Yes.
So basically, what you're putting out on your educational product is basically what you're doing for yourself and the people you manage money for.
Yeah, the product was originally invented, or whatever, not invented, but started because people were saying, hey, I like doing it on my own, and I respect that you manage money. I do it on my own, but I'd love some ideas, and I'd love you to, know what you're doing. Just same thing. So that's, for people who are looking for those types of ideas, it's there. And I know you have a great service, if you want to talk about that with your swing trades, because I've heard great things about that as well, to give people a little bit of a description of what you do on there.
Yeah, we see here the background, find these stocks before they break out. That's what we do.
That's what you do. We buy stocks and we make money.
Right. So, but what's funny is that even like on the hedge fund level, where you have these sales traders that work for, whether it's Deutsche Bank or Citibank, even hedge funds are paying some significant money to these core sales traders for information flow.
Yes.
And a lot of people don't get that. That even some of the big hedge funds are out there. I mean, look, for example, one of the best ones, Stanley Druckenmiller, who's out there seeding a whole bunch of different hedge funds. And a lot of times all they want is just information, and you pay for that information.
Yeah. Yeah. I mean, people want ideas. People want idea generation. A lot of people work full time. And I will say this, doing this is a full-time job. And yes, can you casually invest? Absolutely. But you gotta give yourself a longer term time frame. But staying on top of the market, staying on top of when earnings are, staying on top of what their earnings are, when they're having corporate events, when they're having investors meetings, when they're having shareholders meeting, when they're, all sorts of stuff, what other stuff is going on in their industry, what customers they have, ads, surprise, just there's so much going on that this is a full-time job. And people, like you say, will pay for that information to say, you know what, I don't have the time to do that. There's someone else who can do that. For example, with you, I want some setups. You're doing the work for them, and just give me the setups and I can trade them on my own.
Right.
And there's a great fit for that.
Right.
Yeah.
All right, boys and girls.
Everyone's saying thank you. They appreciate it. We appreciate you guys listening in. Thank you so much. Hope you learned something at Zortrades, at Zortrades, at Jay Fahmy. And we hope to do another one of these soon.
All right. Be well, guys.
Thank you, Frank.